Welcome to the deep dive. Today, we're really digging into Dollar Tree's second quarter results for fiscal 2025 and their guidance looking forward. Our mission, simple: pull out the key insights you actually need. Okay, let's unpack this. So, jumping right into Q2 performance, honestly, some big numbers really pop out. Adjusted diluted EPS from continuing operations came in at $0.77. Now, just for context, that's a massive 92.5% beat or forecast. Huge. And their net sales up 12.3% year over year, hit $4.6 billion. But these aren't just numbers on a page, are they? What's the immediate story for you here?
Yeah, you're spot on. The immediate story isn't just survival in this, tough retail climate. They seem to be thriving in some really specific ways. Like you said, it's not a small beat, it's significant outperformance. And what's really telling, quite fascinating actually, is management saying this happened, and I quote, against an increasingly challenging economic backdrop. And here's the kicker: no major holidays or big traffic events in Q2 to drive that. So that suggests pretty strongly, I think, that their core value proposition is just really hitting home with consumers right now, even when things are tight.
That's a really important point. Not just that they sold more, but how. So, digging a bit deeper, Dollar Tree's same store net sales, that key metric for existing stores, up an impressive 6.5%. And what's great is how balanced it was. It wasn't just one thing. You had a 3.0% bump in customer traffic, more people coming in, and a 3.4% increase in the average ticket. So, people spending a little more each time. But here's where it gets really interesting for me. This growth wasn't just essentials. Yeah, consumables were up 6.7% solid. But discretionary items, think home stuff, crafts, party gear, they jumped 6.1%. Now, when people are feeling the pinch, why are they still buying those, non-essentials at Dollar Tree? What does that discretionary growth tell you? It's their best since Q4 2022.
It's a fascinating look at consumer behavior, isn't it?
Yeah.
Especially now. Sometimes, in tough times, those little affordable discretionary things become like small treats. A bit of stress relief people feel they can afford. Maybe not the big splurge, but it's a $1.25 item. Yeah, that feels okay. It's an accessible bit of joy. Dollar Tree's really tapping into that, and it says a lot about their Dollar Tree 3.0 strategy, expanding price points, mixing up the products. It shows they're broadening their appeal beyond just the absolute basics, capturing more impulse buys too. CEO Mike Creedon actually put it quite well. He said, Dollar Tree is now a fully focused business, and all their attention, capital, resources are aimed at strengthening the Dollar Tree brand. And that focus, that broader value offering, clearly working.
Yeah, that strategic clarity really seems evident here. Let's pivot to profitability then. Gross profit up a healthy 12.9%, $1.6 billion, and the gross margin, that percentage left after cost of goods, it expanded slightly, 20 basis points up to 34.4%, so a 0.2% gain. Now, adjusted operating income rose 7.4% to $236 million, but the adjusted operating margin did tighten a bit, down 20 basis points to 5.2%. So what were the main things they did to boost that gross margin? And conversely, what squeezed the operating margin a little?
Good question. The drivers are key here. Okay, so boosting gross margin, improved mark-on from their pricing moves, basically the initial profit they build in. Also, lower domestic freight costs helped. Lower occupancy costs because higher sales spread those fixed costs out, sales leverage, and a better product mix. But yeah, there were headwinds upsetting that. Higher tariff costs were a factor. More markdowns needed to shift inventory. Distribution costs went up, and shrink. And just for anyone wondering, shrink is that industry term for lost inventory theft, damage, errors. It's a challenge everywhere. And it's really important, actually, to flag one specific thing that hit the adjusted EPS number. There was this positive impact relative to expectations related to tariff timing of $0.22 in Q2. Basically, some expected tariff costs got delayed or booked differently, giving Q2 a temporary boost. It's timing, not permanent, and management expected to reverse later. So for you, the listener, it's just a detail showing how external things like trade policy can swing earnings, even temporarily.
That is vital context, yeah, especially as we look ahead. Okay, so we've got the strong top line, the kind of intricate margin story. But for a company changing this much, the financial foundation is just crucial, right? How are they funding all this? What's the balance sheet look like? Well, the huge move was selling Family Dollar. That closed July 5th, brought in $1 billion purchase consideration. Net proceeds around $800 million after adjustments. They got $665 million right at closing. And interestingly, there are still transition service agreements, TSAs, up to 18 months. That brought in $8 million income in Q2. Essentially, Dollar Tree is still providing some services to ensure a smooth handoff, On the storefront, definitely expansion mode. 106 new Dollar Tree stores opened in Q2. And significantly, 585 stores converted to that 3.0 multi-price format. They finished Q2 with 9,148 stores total. And all this is backed by a pretty strong cash generation. $639 million net cash from operations year to date, $145 million free cash flow from continuing operations. Ended the quarter with a decent $666.3 million in cash, and they're definitely active with capital management too, share buybacks. 5 million shares bought back for over $500 million in Q2. That brings the year-to-date total to $1 billion, 11 million shares. And debt management's also a focus. They redeemed $1 billion of their 4% senior notes back in May. Used cash and commercial paper. These are pretty aggressive financial moves. What do these actions, especially selling Family Dollar, paying down debt, tell you about their strategy and agility?
Oh, they're not just aggressive, they're super strategic, purposeful. If you connect the dots, selling Family Dollar, paying down debt, it massively simplifies the business. And it strengthens the balance sheet, no question. So for you listening, this means they're shedding a complex, often lower margin business to just pour everything capital, focus into the core Dollar Tree brand. It aligns perfectly with what they've been saying. Reinvest in Dollar Tree, dedicate resources to its growth. It's about streamlining, optimizing, very deliberate. But here's where it gets kind of fascinating, right? Despite these really strong Q2 numbers, these savvy strategic moves, Dollar Tree's stock actually dropped 7.5% in pre-market trading right after the announcement.
Yeah, that seems counterintuitive. Why the dip when the results look good and they seem to be making the right internal moves?
Exactly. It raises that question. And I think this stock reaction isn't just about Q2. It's a reminder that even fantastic current results don't completely shield you from those bigger macro worries. Investors are basically saying, okay, great quarter, but what about the potential storm clouds? It signals a very cautious forward-looking market, especially for value retail. They're likely weighing the strong Q2 against wider concerns. The volatile consumer, inflation still lingering, and those tariff impacts, which are still kind of up in the air, especially from China. It's complex. The market's looking past the quarter. That's a key takeaway.
That is a crucial insight. The market always trying to price in what's next. So, okay, with that caution in mind, what is the company telling us about the rest of the year? Let's look at their full year fiscal 2025 outlook. They've updated net sales guidance, now $19.3 billion to $19.5 billion range. That's based on comparable store sales growth, that same store metric, again, between 4% and 6% for the year. Adjusted EPS from continuing operations, the updated range is $5.32 to $5.72. And they expect gross margin to improve about 50 basis points, 0.5% for the full year. So looking at that outlook, especially with the tariff uncertainty you mentioned, what's the biggest unknown for them in the second half? How well can their strategies actually fight it?
Yeah, the tariff situation is, without doubt, the big variable. Remember that $1.20 positive EPS timing impact in Q2?
The temporary boost.
Well, management's been clear. That's expected to reverse in Q3. So those higher costs are coming. And this really brings up the question about their comp guidance for the back half, which is, a pretty wide range, 2% to 6%. Management says that width is due to ongoing market volatility, unpredictable shoppers, and crucially, not knowing the full tariff impact yet, especially with China tariffs not finalized until November. It just highlights the tricky environment they're navigating. A wider range makes sense.
So how are they actually planning to deal with these tariffs? You mentioned that timing benefit is reversing.
Right, so costs are coming.
They laid out this 5 levers strategy, didn't they?
They did. It's their playbook for handling cost pressures, especially tariffs. The levers are 1, negotiating harder with suppliers. 2, respecting products, basically, finding cheaper ways to make things without hurting perceived quality. 3, shifting manufacturing out of high-tariff countries. 4, dropping unprofitable items, what they call non-economic SKUs. And 5, the last resort, is adjusting prices.
What's really insightful about those levers? Is it just standard practice or something more?
Well, what's insightful isn't just the levers themselves, but how they show this multi-layered defense. It's not just one reaction, it's a thought-out strategy. Shows they're thinking ahead in this, volatile supply chain game.
Yeah.
For you, the listener, it shows the company being proactive, trying detailed steps to protect margins, not just automatically passing costs on to you, which ties back to that value commitment. And speaking of pricing, they said there was minimal pushback on recent price changes. Unit volume impact was less than they expected, which really reinforces that their value proposition is strong. And remember, even with changes, 85% of their stuff is still $2 or less.
That's a powerful point about keeping customers on board. Okay, beyond tariffs and pricing, what else is new? Anything on the innovation side? The Uber Eats partnership caught my eye. That seems like a big move. Aimed at 25 million new younger customers. Covering 8,500 stores. What's the early read?
Yeah, the Uber Eats deal is a great example of being agile, responding to how people shop now.
Yeah.
Convenience for a generation that expects delivery. Early results, they said, are promising, driving bigger baskets, reaching people who might not walk in otherwise. Could be a real long-term growth driver.
Makes sense. What about their real estate plans?
Still growing. Plans for about 400 new Dollar Tree stores this year, and converting those last 31 Family Dollar combo stores into full Dollar Tree stores by year-end, tidying things up. And on consumer sentiment, despite doing well with middle and higher income shoppers, apparently 2/3 of new customers earn over $100 K, which is interesting.
Wow, really?
Yeah. But management is still just cautiously optimistic. They see the overall volatility, inflation, cost pressures hitting everyone. So it's a balanced view.
Yeah.
Happy with their performance, but realistic about the headwinds out there. And maybe just briefly touch on other costs they flagged. Rising general liability claim cost not more claims, apparently, but higher settlement amounts. That hits the bottom line. Slightly higher shrink, as we mentioned. And markdowns are still a factor.
So, yeah, executing well, but not totally immune to industry pressures. And for the really deep dive, long-term view, keep an eye out for their Investor Day, October 15th. They'll share a refreshed strategy and financial outlook then. That'll be key.
Okay, so this deep dive, it really paints a picture of a company, Dollar Tree, not just, weathering a storm. They seem to be actively reshaping things. Selling Family Dollar, pushing hard on store initiatives, managing costs pretty dynamically, and their ability to broaden the product mix, pull in new customers from different income levels, try things like Uber Eats. It highlights a really active approach that seems to be working right now, even with all the volatility. Absolutely. They are laser-focused on strengthening that core Dollar Tree brand. And that 5-lever strategy for tariffs, plus just strong operational execution. That's central to protecting their margins in this, let's face it, complex environment. They really believe they offer compelling value that works for customers no matter the economy. And Q2, well, it gives pretty strong backing to that belief.
So wrapping up, what does this all mean for you, whether you're watching the stock or just shopping there? As Dollar Tree pushes deeper into multi-price, expands its footprint physically and digitally, what's the lasting ripple effect going to be on what we expect from value retail? And how might their focused strategy shake up the rest of the market? Something to think about.